Bloomberg Audio Studios. Podcasts, radio, news. Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Nvidia's latest sale forecast draws a bearish response from investors with concerns over a potential bubble still weighing on the company.
Plus, we break down more tech earnings with the CEOs of Snowflake and Chime later this hour.
And Warner Brothers Discovery and Paramount both out with earnings too as the bidding war drama continues. Let's get right to our top story. Nvidia is now down around 5%. Earlier in the session, it had been down and on track for its worst day since April of last year. It is a change of direction and sentiment from where we traded in after hours in its earnings print. The forecast for the fiscal first quarter is sales of $78 billion plus or minus 2%. Interesting margin guidance. That sales forecast does not include any contribution from data center revenues from China. Let's get to Bloomberg's Ian King, who leads our coverage of this name. It was all about the outlook. So that's the data point, $78 billion of sales there or thereabouts. Actually, Jensen Huang and Colette Kress, the CFO, went beyond that to say that $500 billion guide, which is just Blackwell and Rubin, actually they're probably tracking ahead of that. Now the stock is down 5%.
Yeah, you're breaking down the numbers, and we tried to do the same. I spoke to numerous people after the report yesterday, and nobody is pointing to any number and saying that's a problem, that's worse than what we're expecting. Across the board, they were saying the numbers were better than we expected. If there is an identifiable problem, it was this amorphous idea that, well, where's the news story? What's going to take this to the next level?
And is that GTC, Ian?
That was the conclusion that people have come up with, that, you know, they want Jensen to walk out on stage in San Jose like he does and tell them something new and exciting, show them a new path forward. And that was the end of it, really.
GTC is Nvidia's big showcase for the audience and those that aren't familiar with it, and often they do come out and say something quite big. There were other bits in there. For example, if we continue to talk about how this is a supply-constrained industry, right? Detail about how they have inventory and capacity for several quarters, but a warning at the same time from Colette Kress that actually supply is still something to think about. How are they managing the world of intense AI compute demand?
Yeah, I mean, that's just one of the questions that they had to answer and did. And the answer was, look, we've spent a lot of money. We've got a lot of inventory ready. We can support growth into 2027, right? So asked and answered. At the same time, people were like, oh, what about memory chips? What about, you know, high-end capacity? And she just said, look, it is tight, but we have what we need for now.
Bloomberg's Ian King with the breakdown. We thank you. Let's get more on Nvidia. Srini Pajuria is with us, RBC Capital Markets research analyst. He has an outperform rating on the stock, has raised his price target from 240 to 250. And you're not alone, Srini, because I'm looking at Truist Securities raising their price target. Citi did, JP Morgan did, Morgan Stanley raised their price target and called it the largest, cleanest beat and raise in the history of semis industry. What was missing?
Right. I mean, they delivered on everything. They checked all the boxes. You know, for Nvidia, given their track record, the expectations are always high, and they were high this quarter, and you know, they came in well above even the high end of the so-called whisper numbers. And also, they talked about visibility extending well into 2027. And if you look at the breakdown of the quarter, what led the growth was interestingly the non-hyperscaler business, which is kind of, suggests that, the AI momentum is spreading into, the broader markets like enterprise and smaller cloud customers, et cetera. And then in addition to that, networking was particularly strong. That's also a positive sign in our view, because networking is a market where Nvidia is actually gaining share. They don't have as dominant as a position as they do in compute. So, I would say those are actually, definite incremental positives in the quarter. And then there were some concerns about gross margins heading into the print. And, they guided to mid 70%, despite the fact that memory pricing is up, more than 100% this year. So, as I said, they checked every box. I think the reason for the stock reaction, if I had to guess, is, the concerns about the broader AI spending sustainability. So, that's more of a market concern as opposed to anything that they said on the call.
Talk about that sustainability, because you've just outlined how they're managing to diversify their end customer. About 50% of data center demand was from hyperscalers, but they are looking to sovereign AI and the like. Are we needing to hear more about growth in China, for example, which again isn't being factored into the forecast? How much can we support that the capital expenditure is going to last through 2027 fiscal?
Yeah, so look, it's the adoption is broadening. There's no question about it. We are seeing that, on the enterprise side, on the sovereign side, China is kind of a little tricky because, there's a lot of geopolitical issues here. The good thing is that the management did not include any China revenue in the guidance. So if it comes through, it's upside to the model. I think it's going to be incremental longer term. We're not counting on China. You look at the valuation. It's in the low to mid 20s today on forward numbers. That's pretty attractive for a stock, for a company that's growing. It grew 70% plus. Obviously, that's not sustainable. But our expectation is that even in 27, this company can grow at least 30%. And at this level of gross margins and profitability,
Srini,
I think that's a particularly attractive valuation.
In your risks to rating column, in your research note, very clearly, hyperscale spending is a leading indicator for AI demand. Jensen Huang was asked that on the call. This is what he said.
I am confident in their cash flow growing. You need compute capacity. And that translates directly to growth, and that translates directly to revenues.
He was asked about capital expenditures growth going forward. His answer was confidence in cash flows, because, of course, cash flows have been impacted by the CapEx commitment. He didn't really answer the question, but what did you interpret from what he did say?
Look, at the end of the day, the spending has to have a return, right? The ROI is very important, but we're still very early in terms of the AI cycle. And part of the reason we are seeing this, elevated spending is that the competition among these big 4 or 5 hyperscalers is pretty intense. It's still, the battle for leadership is still not settled. I mean, just recently, Google took the lead in terms of the large language model performance, and you have OpenAI, Anthropic right behind them, and XAI. So the competition is quite intense, and we don't expect that battle to settle anytime soon. So it's not so much about ROI right now. Longer term, it does matter. Of course, we need to generate free cash flows for the investments that these companies are making. But at the same time, right now, it's more about the competition and the battle for leadership in AI, in my view.
Very quickly, Jensen Huang sprung to the defense of the software industry. Is the ecosystem of his other customers healthy?
Yeah, I mean, look, I'm not an expert on software, but at the same time, we are seeing broadening adoption of AI in the enterprise. His view, as he stated yesterday, is that AI is more of an agentic in nature. The software, essentially the tools. Our software team agrees with that. Our software has been positive on the sector, but at the same time, I'm not an expert in that sector, so I'll probably refrain from commenting on that.
Srini Bajuri of RBC Capital Markets, thank you very much. Coming up, Snowflake CEO joins us to talk about his company's earnings and the fears of AI-driven disruption. That's one mover to the upside. This is Bloomberg Tech.
Snowflake, another of the tech names that released earnings yesterday after the bell. And as investors look for signs of AI adoption or disruption, its forecast product revenue for the current quarter will be about $1.26 billion. That's up 27%. They reported more than 9,000 accounts using Snowflake AI features. Shares, you can see, up 3.7%. Let's bring in the Snowflake CEO, Sridhar Ramaswamy. Sridhar, I'm reading notes, Mizuho saying bookings were a standout. They're talking about the 7 9-figure deals that have come. Where are those deals coming from? What are those customers demanding of you?
Great to see you, Caroline. Yes, we had 7 9-figure deals, including a mammoth $400 million deal. It reflects the confidence that our customers have, both in where Snowflake is right now, but importantly, where we are going. We all understand that software is being disrupted by AI in a very, very big way. But what our customers understand is that for enterprise AI to truly succeed, they need a single source of enterprise truth. They need built-in security, auditability, trust, and access. Of course, you also need the best models. That's what Snowflake provides for them. And we're creating great products like Snowflake Intelligence, that put the power of data into the hands of every business user. The health company loves using us, and there are lots of partners that are using products like Cortex Code to speed up what can be done with Snowflake. They're really looking to the future and making sure that we can deliver value with Snowflake, and we are creating the products that help them deliver that kind of value day in and day out. That's why you're seeing companies, as I said, make commitments of $400+ million with Snowflake.
I'm really interested in Codex Code was something that was talked a lot about
That's
on
right.
the call, and people are adopting swiftly. But that partnership model that you have, the fact that you have integrations with Anthropic, OpenAI, Cloud, also Google Cloud, but some of these have very good coding tools of their own. How do you see this ecosystem evolving? Because customers get it, but the investor base have been questioning whether they'll take away your market share.
Well, so there are a lot of things that are specific to Snowflake and to data. Absolutely, there are coding agents that are often provided by the model companies themselves. But we know a lot about how data systems are supposed to work, about how Snowflake is supposed to work. And Cortex Code is super tightly integrated with the customer's Snowflake account. Data does not go anywhere. And remember, we have earned the trust of all of these customers with certifications, with the guarantee around things like AIUs. We never use customer data for things like training models. They get the superior models that we get through partnerships with these folks, but we also add the secret sauce of data of how Snowflake works into products like Cortex Code. And we are seeing amazing wins both internally and also externally. One of our partners told us that having Cortex Code was like Snowflake supplying them with bulldozers, where previously they had shovels.
Sridhar, one of the core pillars for you to grow is to go out and find new customers. And I wondered if you just give some detail on what's happening in the world of technology, in AI, that would bring a customer to Snowflake for the first time. What is it that they need that they didn't before?
Typically, they come to us because they need better insight into data. It is sitting somewhere. It's hard for them to get these insights. But increasingly, what we are able to do is have our sales team build an honest-to-goodness customized demo of something like a Snowflake Intelligence on data on the kind of data that a customer is going to have. It is that easy access that really, is the big winner for our customers. And smart customers are also quickly realizing that having data in Snowflake means that they can think about how this data is going to be used in ways that they had not done before. Sanofi, which is an existing customer, is now using Snowflake Intelligence, our AI products, to redefine a lot of workflows, replacing a lot of existing software. These are the use cases that drive these customers to come to Snowflake and adopt it.
Sridhar, last night, Jensen Huang, who you know very well, talked about profitable tokens, the idea that the output of an AI model is worth paying for, customers do pay, and they pay at a price that is greater than the compute used to generate it. Are you able to give me any evidence through Snowflake's lens that you actually see that in the real world?
Well, what I can assure you is getting projects done has been changed dramatically. Something like setting up a pipeline used to be a multi-week task. We can get that done in a small number of hours. My teams come to me just last weekend with speedups going from 4 weeks for a software engineering project that they did down to 40 minutes. That is 100x speed up. And we are happy to spend any number of tokens in those 40 minutes to save that kind of time. I think coding agents are really quite magical in the value that they deliver. And I think it's only going to accelerate from here. And so these investments are going to be pretty foundational in every company succeeding and thriving. And that's why we are so bullish about Cortex Code.
And how much are you having to invest in your own business? I mean, the bull case for many is you need to keep up with a furious pace of innovation. Can you, at this moment, briefly?
We can, because we are organized to drive rapid innovation. The team that is driving a product like Snowflake Intelligence is not that large, but we have structured it in such a way that they can make rapid progress. And it is more the meta structure of how you set up environments where people can get work done quickly and effectively. That matters a lot more than things like how much hardware you're investing in and things like that. The current moment is magical because all of us have access to great tools. It really comes down to how effectively we set up teams and projects to get things done. And that's why we are very bullish on how we have set things up at Snowflake, because we now have a demonstrated capability to be right at the cutting edge of where AI is having impact.
Snowflake CEO Sridhar Ramaswamy, great to have you back on Bloomberg Tech. Thank you very much. Now, coming up continues, and this time it's with Hollywood. We'll discuss results from Warner Brothers and Paramount. That's next. This is Bloomberg Tech.
Our board continues to lead a rigorous, highly competitive, and thorough sales process. We engaged with 4 bidders, which led to 8 price increases, and have thus far achieved a 63% increase in value versus the first offer received in September, delivering significant value for WBD shareholders throughout the process.
Warner Brothers Discovery CEO David Zaslav there discussing the progress of deal talks. An increased offer from Paramount has renewed the takeover tension, and it comes as Warner Brothers posted a 6% decline in revenue during the fourth quarter. Paramount, Skydance also came out with its numbers. Let's bring in Bloomberg Media reporter Hannah Miller. And all of this speaks to still profitable cable companies where they're trying to subsidize basically revenue, well, profits not showing up in streaming thus far, but subscriber growth is there.
Yeah, the subscriber growth is there, and Warner Brothers has made a point that they want to build up that subscriber count. They're shooting for 150 million people for their streaming services by the end of this year. And we have seen these gains, but again, they're overshadowed by the fact that revenue earnings have declined compared to last year.
There's also this idea of like what's happening with the bottom line, and we can't get away from what's happening in the background. It's awkward when you have company earnings and all the players involved are in a kind of bidding war. Did they explain any of that, Hannah?
Yeah, so, all of these earnings results, they've been overshadowed by this bidding war. And we saw on both earnings calls that, the CEOs were like, we don't really want to comment on this. Things are still underway. What's happening right now is the Warner Brothers board has to determine whether or not the Paramount's most recent offer could be considered superior to their current agreement with Netflix. If they do make that declaration, Netflix has 4 days to respond with either a sweetened offer or just bowing out.
Bloomberg's Hannah Miller, who's been across all of this in real time. Thank you very much. Let's move on to another big media name, Paramount. It posted $8.15 billion in revenue, and the shares, again, it's kind of interesting. They're reacting significantly. We're up 11%. Are we up 11% because of the health of the business and the content of earnings, or are we up for another reason? Let's discuss with Laura Martin, Senior Entertainment and Internet Analyst at Needham & Company. Laura, you're recommending fundamental investors remain on the sidelines. I just showed the chart. Maybe they'll bring it back up. It's up 11%. Reconcile that, please.
Right. So I think what Wall Street likes is the fact that this company is subscale, and it looks like they're more likely to win the bid for Warner Brothers, which would then not make them subscale because they would be like a third of total linear channels. They have owned 2 of the largest film studios. And really their revenue is up 2%. They had a lot of positive comments about UFC, which was their top rated streaming channel, and streaming revenue was up 17%, Paramount Plus in the fourth quarter. And it should, all of those numbers fundamentally were better. At least this business is growing. Warner Brothers is shrinking, but Paramount, P-Sky is growing still.
I think we'll get to Warner Brothers in a moment. Really simple question, and it comes from a sincere place. A lot of our audience have this. Based on what you've just outlined with Paramount Skydance, what does doing the deal with Warner Brothers Discovery, the whole entirety of it, fix or improve or accelerate?
Okay, so if they don't win, if Netflix wins instead, they're an $11 billion market cap company, and their primary competitors will be Netflix, which if it buys Warner will be a $500 billion market cap, and Amazon and Google, which are $3 trillion, round numbers. So its competitive position, it will be more subscale than it is today. If it wins Warner Brothers, it suddenly combines and cut costs from several of the largest streaming companies, several of the largest, it will be 30% of total linear TV ownership, and it will have two of the biggest studios. So there's a lot of cost cutting in that, and it will not be near as subscale. Round numbers, it will be around the same size as Disney and Netflix if it wins Warner. So it basically makes it a legitimate competitor to those other streaming companies.
And I think what Paramount Skydance, Laura, did in its numbers was showed they can cut costs and then some, certainly when it comes to the cable part of the business. How much does it need Warner Brothers Discovery?
So good question, because price is the thing you're not asking. But strategically, it must have Warner Brothers Discovery. But of course, we do stocks and we do valuations, and they're paying an awful premium for a shrinking business, as you saw. Like every single business segment, advertising was down, a lot at PSky. So some of their businesses at Warner Brothers are shrinking, or a lot of them are shrinking, actually. So, they're buying a business is weakening fundamentally every single quarter, and they're paying PSky bidding higher and higher values, which implies they're not going to get a good price on this asset because of the bidding war.
Laura, you're all about the fundamentals, but if they do have to pay over and above, they have to go to $32 for Warner Brothers Discovery, is that a good deal fundamentally for the business longer term? And given maybe Netflix happens to be able to push them there?
I think the answer is, if they didn't have a billionaire behind this, I cannot imagine a investor, a venture capitalist, a private equity guy, or public markets funding this stock price. But you've got a billionaire sitting behind it, and he can spend his money the way he wants.
I'm talking Larry Ellison, dads of David Ellison, of course. Laura Martin, it's always so great catching up with you. Thank you from Needham & Co. Coming up, more earnings. How are results impacting the AI disruption fears that engulf this market, particularly in the area of software? We're discussing that next. We're also talking hardware. Ed, Nvidia, we've got to talk about the slump there.
Yeah, look, it's clearly having a drag on the market. We're not down as much as we were, but still down 4%. And it is a sentiment change. We've gone from basically muted on what was a beat, even against bullish buy-side expectations, to a very bearish reaction to what Nvidia had to say about the durability of this AI spend. And there is a lot more to unpick, so much more analysis and reaction to come. It is halftime, and this is Bloomberg Tech.
Welcome back to Bloomberg Tech. It is a big day in the markets because it's a big day of earnings, and the number one most valuable company in the world has failed to impress. What more is Nvidia to do? It's up by 3.9%. They saw 73% increase in revenue for the quarter that they posted for a giant that is worth $4.8 trillion. They say that that's going to accelerate to 78%. They see margins that are expanding as well, but yet the market isn't convinced. And still we see the stocks roll over across the board when you're looking at AMD down, Broadcom, Micron, the force hardware lower. Let's look at software though, because earnings have also been coming thick and fast there, both actually in the green. Snowflake, we just had the CEO on talking about how they're able to be at the epicenter of the enterprise AI adoption, and for now investors believe that. But I'm looking at Salesforce managing to turn around. It was down after market yesterday. They posted a $50 billion authorization to buy back shares. We're seeing an adoption of Agentforce that is now at $800 million run rate, up from 500. We're up 2.5%, but both of these stocks have been battered over the course of the last few months, Ed.
Okay, let's get more on Salesforce's earnings and speak with Bloomberg's Brody Ford. And 24 hours ago, when you were on the show, we were saying this is going to be about them evidencing organic growth versus inorganic growth. And actually, that did come up. They talked about, whatever's happening in AI, the thing that they're offering will help them grow, as opposed to just buying up other companies that are growing fast.
Absolutely. So, the big concern is that the core Salesforce products for, let's say, managing your Salesforce or managing your service, these are slowing down quite a bit. And so their new AI tools, they are making some money, $800 million per year at this point. Is that enough to offset the slowdown in the core business? I mean, they're in the green today, but we have to remember application software has been incredibly beat up this year. And if you zoom that chart out, it's still not an amazing picture.
It's an ugly picture, in fact, if you're looking over the course of the last 12 months, Brody. And in terms of agent force adoption, in terms of that average revenue run rate, are we seeing them being able to prove out that they're so intertwined, no one's going to be forcing out the platform, and it's more just a question of how much they can charge for it going forward?
They have proven at this point that Agentforce is a real product. People are paying for it. That was an open question 12 months ago. What's less clear is, do they have a ton of pricing leverage? Are customers increasing total spend with Salesforce, right? I mean, is this a question of you're spending money on Agentforce, but you're not expanding your seats on the core platform? The jury is still out on whether generative AI means that leading platforms remain this kind of center of gravity.
Brody Ford, we thank you, as always, for talking us through software. Let's talk about how the markets are digesting all of these earnings. We're going to go back, of course, to Nvidia's results as well, with none other than Nancy Tengler, CEO, CIO of Tengler Investments, who joins us on our birthday and also our Super Bowl day, that is Nvidia. But let's just start with software for a minute, Nancy. What do you make of the software numbers that we saw from CRM, that we see from Snowflake as well? Did they manage to push back on this disastrous fear engulfing the market that generative AI is going to eat their lunch?
Yeah, thanks, Caroline, for mentioning my birthday. Goodness sakes. Pretending like I don't have them anymore. I do think that some of these companies are facing some really strong headwinds. We got out of Salesforce a while ago, not because we knew this narrative would prevail, but we just didn't see an exciting growth trajectory for the company. We also became a client. It was not a great experience, and so we canceled our contract. But in terms of software in general, I think some of these companies are going to win. And I've talked with you in the past about ServiceNow. We still own it. We added to it recently. We think they are going to benefit from better margins in the future because they're pivoting and vertically integrating. But we got out of Adobe, and that was because we didn't see the company pivoting, and that was a number of years ago, or over a year ago. And so I think that's what investors have to digest, is who are going to be the winners. And Salesforce will be in business, but they may not put up the kind of growth numbers they've put in the past. And we won't know for a couple of days, because it was down pre-market, then it shot up, and now it's pulling back. So I think you have to wait for the hedge funds and the algos to settle in, and then we'll see if investors come back to the name, long-term investors.
It's interesting, Nancy, you call out ServiceNow. We know that you've called out before, and indeed Jensen Huang has been on calling out ServiceNow himself as a winner. Nancy, go back to your own, experience with using the Salesforce product. Why didn't you like it? Why did you cut it? What was it that we're not getting offered that keeps it sticky?
So this is interesting, Caroline. I think this is the story of this market. So we were going to use it internally, and as for the obvious reason. And it took almost a year. They assign you to someone who helps you get set up and customize the product. Before we were even up and live, we had a price increase. It was very clunky. It was not a smooth process. A lot of hard sell. Not a lot of delivery and service. We are shifting our investment management software away from Advent to Ridgeline. Ridgeline was built from scratch, new technology, founded by David Duffield. He made the pivot. I mean, he still obviously owns tons of shares in Workday, but that firm is a joy and a privilege to work with. So I think that's what software providers are going to have to do. They're going to have to service and show that they add value to the underlying business.
There is a link here between that and Nvidia's earnings. Your main takeaway from the call last night is the same that we've been talking about all morning. Compute equals inference, which equals revenues. And the way that Jensen Huang explained that was profitable tokens. In other words, customers of all kinds are willing to pay for the output of an AI model, and that actually the economics have improved. The thing is, I don't see any evidence of that in any of the software companies' earnings yet. Do you?
Not yet. I don't think so. Part of that is capacity, though, Ed. I mean, you heard Microsoft say they took some of their own capacity, but you heard them say and Amazon too. We can fill whatever we get immediately in terms of demand, but they don't have enough capacity. So, I guess I would look at it two ways. One is if you go back and look at CapEx in the 90s, it was about a 2 standard deviation above the mean spend in tech CapEx. We're not even 1 standard deviation away from the mean, and one man's CapEx spend is another man's revenue. So AMD, Nvidia, Broadcom, names we all own, will continue to benefit. And here's the last thing I'll say. 60% earnings growth at Nvidia, a PE of somewhere around 23 to 24. Procter & Gamble, 2% earnings growth on next year's earnings and a PE of 24. So I know which one I want to own for the long term, but there's a lot of trading going on. There's a lot of hiding in the defensive names. That's what happens during this period. It happened last year.
Right.
If you look at all these names after DeepSeek, where we thought the world was ending, I mean, we were buying Nvidia at just over $100 a share. That's still a good investment.
You are an Nvidia shareholder. I think you continue to like the name, right? So what was your big takeaway from any of the earnings print or the call?
Yeah, I think no one's really talking about the growth in sovereign, which is just getting started. So I understand it's a small portion of total revenues. It was $30 billion last quarter, up 3x year over year, though. And I think
excluding China, right?
Yes, excluding China. I think that's important. And the company, it's just like when Tesla's Megapack business got started, it became the fastest growing, most profitable business. I think we will continue to see these companies expand their reach, and more compute is going to be more demand. And we are going, I think he made a really interesting comment. What if when we have 100% autonomous cars, let's call it 50 or even 35 cars that are autonomous, the compute demand is going to be great. And those data centers in space, while super intriguing intellectually and capture the imagination, that's not going to happen very quickly.
Nancy Tengler from Laffer Tengler Investments, thank you very much. Now, coming up, more earnings. We're going to speak with Chime CEO Chris Britt following that company's report. This is Bloomberg Tech. Okay, shares of Chime are up almost 11%, more than 10%, on track for their best day since November. Earlier in the session, up almost 17% and on track for their best day since the company IPO'd last June. The fintech firm issued guidance that topped analyst expectations, driven by rising user growth, strong demand for digital banking products. Chime CEO Chris Britt joins us now. Actually, the other thing you're getting a lot of credit for is a technology story. A lot of the transition to your own tech stack, how you've managed the company. You don't need to grow headcount necessarily because of the focus and investment you've made on tech. Do you mind if we start with that and explain a bit about the strategy behind that?
Yeah, absolutely. And first of all, thanks for having me today. I'm so proud of this team and the way that we've executed. I think we're shipping faster than ever. And, if you just think about this first year this is the first time we're reporting as a public company, our full year results, and they were outstanding. We added 1.5 million new active members, so we're now at 9.5 million actives. We took the company public. We launched a range of new products. We launched a new business in our enterprise channel. And yes, to your point, we completed the conversion of our core processing and ledgering system onto our own in-house tech stack, top to bottom. And that's really unleashed not only lowered costs, but also unleashed a whole set of new products and services for our members that drove awesome results for the year of $2.2 billion of top-line revenue, growing at over 30%, and we got to a 10% EBITDA margin in Q4. So feeling good across the board, and this technology platform really is an enabler for our future growth.
Last month, I was on your own website. You did this kind of blog post. It was, "What is Chime?" Chime is not a bank, but if you consider, what the products you're offering are, a big part of where the street's focused on is new products coming to market and how you've monetized that. So you take Chime Card, for example. Through that lens, explain what you are, but also how you've been able to launch a sort of wider offering of financial services as a fintech company.
Right. Chime at our core, we're a technology company. We partner with banks. And so when you sign up for a Chime account, think of it, you're basically there's a three-way relationship between the consumer, Chime as the technology enabler and brand, and the design and delivery of all the actual experience, and then the bank. So we have some community bank partners that actually hold the deposits in FDIC insured accounts for our members. And this approach has worked really, really well, particularly for mainstream American people that oftentimes live paycheck to paycheck, basically the population that makes up to about $100,000 a year. That's the segment that we serve, and we offer a range of core banking services, fee-free checking accounts, the ability to get access to short-term lines of credit at low cost or no cost, the ability to build your credit and to earn high-yield savings. And because we're a technology company, we don't have physical branches and a heavy physical infrastructure. We're able to operate at a really low cost structure, and we deliver that value back to our consumers. And that's allowed us to really outmaneuver the big banks. We've been continuing to increase our share of new accounts, new checking accounts in America, and third-party research continues to show that we are having an outsized impact and increasing our share.
Let's go to swipe fees, because that is where you get a lot of the revenue. Is there any issue, any concern longer term as you scale that will become a regulatory issue as you hit certain benchmarks and amounts of money that you manage?
Yeah, I think as we've grown over the past few years, you've seen an increasing balance in our business. So we were historically very heavily reliant on fees that we earn from Visa when our debit cards get used for everyday transactions. And we've now have a secured credit card product. We launched a product called Chime Card last year. That's a secured card that has rewards. And that's kind of changed the game for everyday transactions in America for average people, average sort of mainstream consumers. And so that's also a contributing revenue line. And then increasingly we have other services, our short-term overdraft services, and our MyPay product has been an outstanding, just 1 year in, it's almost a $500 million revenue run rate that allows our members to get access to their paycheck essentially on demand. And that's also been a nice, added some additional balance to our revenue mix.
I'm going to ask a sort of more complex and maybe a more emotive question in some way. You've talked clearly about how you have partnerships with banks. You're not the bank, you're not taking the details of the customer in so many ways, but there has been a consideration from the Trump administration that maybe banks should collect citizenship. Now, given the people that you serve at the moment, briefly, Chris, is this an issue for you?
It's absolutely not an issue. First of all, we open up FDIC-insured checking accounts in partnership with our bank partners. So we comply with the rules and regulations that are required as OCC-chartered banks that offer these FDIC-insured accounts. So for every new Chime member, we collect the full Social Security number and comply with the Patriot Act and all of the KYC requirements to open up a checking account. So any rule changes in this area have no impact on our business.
Chime CEO Chris Britt, we thank you for joining us today. Now coming up, we'll come back on today's big story, Nvidia earnings, how investors are digesting the numbers. At the moment, you can see they're pushing down the stock on the back of it. This is Bloomberg Tech.
Nvidia continues to surprise and delight the market.
Nvidia hit it out of the park yet again. We saw, phenomenal results.
It was a solid set of earnings, and more importantly, they had a very confident outlook for how they were going to sell more AI chips and data center product going forward. And I think we were all looking forward to seeing, is that going to be a thing?
I think what was particularly, maybe not surprising, but impressive was 75% growth year on year on the data center space.
As the market plays tug of war over, is the AI economy booming, or are there concerns around the AI economy? And Nvidia continues to beat regardless of what, this debate is concluding. The stock just keeps getting cheaper and cheaper to the point where it's becoming an obvious buy.
They're still investing, and these are going to, signal good times to come for Nvidia, in our opinion.
Could it be any bigger than this? And they basically said yes.
The reaction, very positive from some of Bloomberg TV's guests after Nvidia posted its whopping numbers. But the reaction in the shares is not. We're off by 4.5%. Let's bring in Bloomberg Tech equity reporter Carmen Reinecke for what your sources are telling you, because the numbers were stellar. Everyone agrees. So what more were they not able to demonstrate?
Yeah, what I'm hearing from investors is that they're really worried about the cyclicality here. That's sort of what they're seeing is, the thing that might be still concerning people. So obviously Nvidia continues to beat and raise. And Jensen even said, they think the hyperscalers are going to continue to spend. But investors are worried about that. They're worried that that's going to stop at some point and that then Nvidia will be impacted.
Carmen, the market is now moving and the move is significant. What are the single names that you're tracking and what's the impact been from Nvidia's move lower?
Yeah, so obviously Nvidia is the big one, but we're also looking at other chip makers. So shares of Broadcom, Micron, we're also down today. They spiked with Nvidia sort of in after hours and then followed them lower. The other thing that's really interesting today is that software names are getting a little bit of buying here. So we saw Salesforce up. That's a reverse from where they were after hours after their own earnings report. And then we're also seeing things like ServiceNow higher. So that's interesting. We've obviously been seeing a lot of weakness in software and maybe a little bit more strength on, in the Nvidia side, although shares have been in range for quite some time. So seeing a switch there today is really interesting.
What's interesting, some parts of the supply chain or other areas that have benefited from the AI capex spend are still showing resilience. I'm looking at Samsung traded in London, for example, is still holding on to gains. SK Hynix had a whopping day over in Asia. So there's still areas that are resilient, the optical part of the equation, for example.
For sure. I think people still are looking at those sort of second derivative picks and shovels, kind of the other place where capex is going to be directed and saying, okay, we still think that there is strength here. They're still building data centers. That's going to continue. And so maybe moving into that piece of the puzzle a little bit more. It's so interesting, though, because Nvidia is getting really cheap. That's something we're going to keep watching. I mean, it's like 23 times forward earnings. That's barely a premium to the S&P 500.
Bloomberg's Carmen Reinecke, thank you very much. Bloomberg Intelligence out with Nvidia earnings reaction, noting the beats in the fourth quarter, but more impressively, that first quarter outlook, pointing to a stronger ramp of the GB300 system. Bloomberg Intelligence senior analyst Kunjan Sabani with us. This was what they used to explain margins, the Blackwell ramp. But then later this year, we're going to get Vera Rubin. There will be a transition of technology for their biggest customers. How have you modeled for that?
Yeah, so usually at the start of a new product ramp, your margins will get hit. But one key thing is different this time is the ramp of improvement of margins with the Blackwell has been very impressive. We all know about the rising memory cost, the rising wafer and package cost. Despite of that, and they don't pass on these costs to their customer, despite of that, they've been able to hold that 75% margins, the software level gross margin. So that speaks to two things, their pricing power and their ability to optimize for cost in their supply chain. Hence that large purchase commitment increase, which really lets them deploy their balance sheet in their supply chain.
I mean, it's even the costs that they identify for stock recompense to those that work for them. I mean, people saying that's a really classy act from the CFO, from investor relations, to be making that clear within the GAAP numbers, Kunjan. But where, therefore, are we lacking clarity? Is it from the China perspective? Is it future build? Where did we need a little bit more?
I couldn't find anything negative in this print. I mean, looking at buy-side expectations, it very clearly cleared the most lofty bogeys on the buy side. I think this is just, the reaction seems to be overall AI fatigue. On one end, when the top 5 customers who are raising capex targets are being punished for spending that money, you can't have it both ways, where the company that's capturing all that revenue also gets rewarded for taking a lot of that high spending.
Just very quickly, networking provided a lot of the upside. Just explain it.
Yeah, people don't pay a lot of attention to the networking, but networking has been surpassing expectations every single quarter, and I think it will greatly, because now their networking, they can sell it even where their GPUs don't go. So even like ASICs for an Amazon, which are supposed to be growing and taking share away from the Nvidia GPUs, they're going to plug it with Nvidia networking. So that's a new source of revenue even where they don't have the chips in the servers.
Kunjan Sabani, it's a bullish take from Bloomberg Intelligence, just not a bullish reaction on the stock. That does it for this edition of Bloomberg Tech. Extraordinary day on these markets, Ed.
Yeah, and we had reaction from the sell side, from the buy side, and in-house the reporting of the things you need to know. Recap that on the podcast. You know where to find it. It's on the Bloomberg terminal and online on Apple, Spotify, and iHeart. This is Bloomberg Tech.